In this video, I'm going to talk about the bank reconciliation. So each month when a company receives their bank statement for their bank account, they will compare it to what they have recorded in their company books for the bank account. And when you start with the bank balance per your books, and you start with the bank balance per your bank, and then you'll make any adjustments for things that haven't cleared, that haven't been recorded on the books, but that were on your bank statement. You'll make any adjustments, and then you get down to your actual adjusted balance for each side, from starting with your books and from starting with your bank balance. And that's a check so that you actually know your actual adjusted balance and that both of those amounts are equal. So you know you've accounted for everything in your books as what's actually happening in the bank account. Then we'll also need to make any adjusting journal entries as necessary for things that were not recorded in the company records, which would be things on your bank account, like non-sufficient funds, any notes collected by the bank, or service charges. So this is a format that we'll use. In this first section, we'll look at the cash balance according to the company. So that's the company's books. And then we'll add to it any unrecorded bank credits. So when you were talking about the banks, credits and debits are the opposite as to when we're talking about cash balances, or just cash as an account in general. As an asset account has a normal debit balance, credit decreases. The bank always considers that the opposite way. So we'll add any unrecorded bank credits to the company's cash balance. So that would be things in general. Textbooks will always use the example of notes collected by the bank. So the bank can actually collect notes receivable that you have due to you, cash people owes you, and they can collect it for you, and it would then increase your bank account. So we would need to add it to the company books and also make an entry to account that we received that note receivable. Then we'll subtract any unrecorded bank debits, which would be things like non-sufficient fund checks. So that means we deposited a check from a customer, but it bounced because they didn't have the money in their account. So although we already recorded this as income in our books, we now need to deduct it because we didn't actually get that cash. And we also need to make an entry for it on our books. Same thing with the service charge. We would need to make an entry on our book. The bank charged us a monthly fee. We see it on the bank statement, and then we adjust our cash balance from the company and also make an entry. So that brings us to our adjusted balance, and that should be equal when we do this same setup, only beginning with the cash balance by the bank, and that's on the bank statement. To that, we add any deposits in transit. So if we deposited checks into the bank account, but they haven't cleared yet, we're going to need to add those because we already recorded those on our books. Then we'll subtract any outstanding checks that have not been cashed yet, and that will bring us to our adjusted balance, and these should be equal. Let me know if you have any questions.